Welcome to another edition of Focus on Alternatives, sponsored by ADISA. I'm Damon Elder, the publisher of the DIWire.com. Today, I'm joined by Brian Mitz, Chief Financial Officer of NexPoint Real Estate Advisors, and we're going to be speaking about a relatively new emergent asset class in the alternative space, and that's single-family rental housing. So Brian, the single-family rental space is an interesting one, and it's a relatively new entrant, like I said, to the alternative investment space. Following the Great Recession of 2008-2009, we saw a lot of large institutions come in and snap up really significant portfolios of single-family homes that had fallen into distress. Some of them were spun off into public entities, others were absorbed into other portfolios. So in recent years, we've begun to see private investors and private placement offerings come along that focus on these single-family homes. What is the intrinsic value to investors? Why should retail investors care about single-family homes? What's the proposition for them?
Yeah, I think the biggest driver of value and returns is the fact that there's a huge shortage of housing. Coming out of the recession, as you mentioned, a lot of the buildings stopped or decreased pretty significantly. So today we have a shortage of housing in the country. And so I think being able to take these houses and lease them out to a lot of times renters by necessity that can't afford a home is a critical driver that's a great fundamental story, and I think has produced great returns for investors, and we think will continue to do that for quite a while, because there's no real solution to this shortage that we see.
How would you compare the typical returns of single-family rentals to investors, and how do they compare to other types of asset classes?
So I think at this point in the cycle, we're seeing a lot of cap rate compression, and returns are dropping quite a bit across real estate. But in single-family rental, there's still quite a bit of growth. It's still a very young industry, and so there's a lot of consolidation that's happening, a lot of new capital that's flowing in. So I think you're seeing probably 2x the returns in single-family rental as you are some of the more established sectors like multifamily or even storage, which is having a kind of a banner year. But yeah, I think single-family rental is done phenomenally well.
It's now really a good entry point, though, considering the fact that, like we said earlier, the big institutions came in and gobbled up a lot of this inventory post-recession when these assets were really, at their lowest probably value in recent times. And obviously, during and post-COVID, if we're at post-COVID yet, we've really seen an uptick in generally speaking, in valuations for these assets. So is it still a good time for this type of investment?
Yeah, I think it is, because although you're seeing prices increase, you're also seeing businesses mature. You're getting better margins. So the returns are still there and increasing. With all the capital coming in, the cost of capital is improving, both for debt and equity. So it's a more competitive environment than it was certainly 12 years ago when the industry really got started. But there's still a lot of compelling fundamentals that are driving returns, and I think it is a great time to get in.
So you talked a little bit about, it's a nuanced strategy in some respects, that either you can target renters by choice or renters by necessity. What's the difference to the two kind of subtle changes in investment strategy? What are the benefits of, perhaps targeting one over the other?
Yeah, so a renter by necessity generally can't afford a mortgage, can't afford the down payment, can't qualify for a mortgage. So that's sort of a customer for life, whereas a renter by choice is usually going to rent for convenience for whatever period of time, but ultimately will become an owner. So a little bit less sticky customer, if you will, for that segment. But I think overall, there's just such a high demand for rental these days, even amongst an age cohort that typically would have been an owner. Historically, they're renting longer, so it's good for both. But I think the renter by necessity is sort of there forever.
Doesn't targeting renters by necessity kind of bake in a little extra risk into your model, or how do you account for that? But I would think they'd be a little bit riskier than maybe those that would choose rentals by choice.
Some would, for sure. So you have to be careful in your tenant underwriting, but Simply because they can't qualify for a mortgage doesn't mean they're high risk necessarily. I think a lot of them can afford the monthly rent, but owning is oftentimes more expensive. So the fact that they can't qualify for a mortgage or own a house doesn't necessarily mean that they can't afford the rent.
I think all of us that own homes recognize it's
more expensive than
much more expensive to own a home. It's not just the mortgage. So let's talk a little bit about other aspects of the strategy, talk about geography. So what do you typically look for when you're looking to purchase, single-family rentals? I assume you like to cluster them, but from a geographical perspective, what are you really looking for?
Yeah, so just broadly speaking, you want a market that has some growth. You don't want out-migration for sure. Within the market itself, what you're looking for are houses and neighborhoods that are safe, so there's not high crime. Generally, good schools. They don't have to be in great school districts, but you want to find the neighborhoods where you have adequate schools, and that's what families are looking for. And then you want a product that's durable. Every house needs maintenance. Components wear out, you got to replace them, but as long as the foundation and sort of the four walls, if you will, are solid, that's what you're looking for. So I think in general that's the kind of overall, which describes almost every market in this country. It's to some degree. So and that's what's so exciting about the business is there's so much housing stock out there that can be bought and turned into a rental property.
I would imagine there are some really unique operational and property management challenges to this asset class. Obviously, single-family homes being, it's not like a multifamily community where they're all located right next to each other and you can hire professionals to maintain the day-to-day. I mean, how does that, pose a challenge to this sort of investment?
Yeah, it's not a coincidence that the proliferation of single-family rental as a business coincides with a improvement in technology. Technology is the key to be able to get your arms around, if you will, a bunch of different assets. And like you said, they could be clustered together in neighborhoods, depending on where you're buying, but not like they are in an apartment complex, obviously. So the scale there is very different, but you could still accomplish it with the technology. And the technology has become a key. A lot of people have developed their own proprietary technology in-house, but there's now a lot of fintech companies that are coming in and taking that technology and improving on it. So the key is technology, and that's how you manage it.
So you aggregate these individual homes into a portfolio. What is the ultimate end play? What's the, how do you get out of the investment? What's the liquidity event? What does that kind of look like? What's the time horizon?
Yeah, so today there's only two publicly traded single-family rental companies. There's another one that has other assets. But I think that going into the public markets is the best way because then you have perpetual capital. And really these houses should cash flow forever. So there's not necessarily a reason to sell them unless you're just looking to rotate out of a market into a different market or recycle capital for that reason. But there's really no reason to sell the entire portfolio unless the returns are just that appealing. So I think that the way you do it is you go into the public markets, you get a good cost of capital, and you keep those assets forever.
And then you just start another private fund and do it over again, or,
Sure. That's what we do, but yeah.
Well, it's interesting though. I mean, again, this is fairly new to the non-traded private space, but and there's only a couple of players out there right now. Obviously, NexPoint's got its offering with Vinebrook and whatnot, and one or two others. But it seems to me like there's a lot of interest there. So I mean, what is the time horizon like? Is this going to be a new class of asset type that the private markets are going to see for the future?
I think so, because there's a lot of capital coming into the space. And so I think the retail capital tends to be attracted to where the institutional capital is going. And there's a ton of debt capital, which in real estate is important. And so you're able to borrow at very attractive rates in single family rental. And it doesn't really seem like that's going to change in the near term. We're clearly at the top of a cycle. We were before COVID. And now it's kind of, with the stimulus been increased into by far the longest growth period in the U.S. economy. So at some point it's going to turn, but I think because of all the fundamentals with housing and the shortage of housing and the demand for housing, that single-family rental is going to come through it pretty well. And we saw that during COVID. There wasn't a lot of bad debt like you would have thought. I think collections were generally very strong across the sector, as were occupancies.
Yeah, and I mean, we definitely have seen that across multifamily and the single-family space. So it's often said that individual retail investors really like to invest in things they understand. Mm-hmm. Obviously, a lot of accredited investors, the vast majority, I'm sure, are all homeowners. Maybe even invest individually in single-family rentals. Is that what you're finding? Do you find that investors are finding an ease of opportunity here by obviously understanding being a homeowner and appreciating the asset class? Are we going to see growth because of that?
I think that definitely helps because you're right. They like to invest in what they can understand. And being a homeowner isn't necessarily the same as owning a home and renting it for profit. But in general, they do understand the basics of that. And so I think it does make for an easy investment decision. And then I think just the fundamentals behind it make it incredibly appealing. So, there's a lot of things kind of coming together that make it a very attractive investment.
And the horizon's a long one?
I think it's 10 years plus.
Oh, okay, great.
Yeah.
So we're going to see a lot more on the SFR space then.
I think so.
All right. Brian, thanks for joining us today. And thank you for watching. For more information regarding all things alternative investment, please visit www.adisa.org. Thanks again.